Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. There was a lack of any significant amount of data yesterday, but there was some sell off in the dollar triggered by the Eurozone current account surplus, which beat the expected number. This caused some rally in currencies against the dollar and gold as well. Good morning, JK. Can you break down yesterday's data for our listeners? Why did the current account surplus data matter?
Good morning, Swaraj. Yes, I'll come to that. But when you said that yesterday there wasn't much data to chew upon, yes, definitely there wasn't much in terms of the normal numbers that we watch. But there were quite a good number of news on inflation-related, and that was coming from various regions. For example, we had a 5-year loan rate in the China cut by the highest quantum of 0.25% to 3.95%. And that was also following a statement from the Chinese premier calling for pragmatic and forceful action to increase Chinese confidence in the economy. So that was the starting point yesterday. Then we had the Australian inflation number, rather the Australian central bank meeting minutes, which showed possibility that they might actually increase the rates once again. There are some warning bells ringing that the recession is not as as near in Australia as it is in some other regions, and definitely cut in global rates are also far away, and therefore the inflation target being far away for them, it won't be a surprise if they hike the rate again. So that was a quite a contrasting stand that we saw. Then we had Eurozone wage growth data that showed that wages were rising for the year 2023 at 4.3% versus 4.5% in the previous year. Again, that strengthens the hand of ECB to look closely at their monetary policy using a timetable. We had Canadian inflation that slowed significantly more than expected to 2.9%, and coming below 3%, of course, well away from their target of 2%. Once again, market started speculating maybe Canada could be the first major central bank to cut rate starting as early as April, but it's too early because just one data. All the same, it was a number that again brought the market focus on inflation and rates. We had MPC members of the Bank of England testimonial to the Parliament, where they were highlighting that the market's view on interest rate cut was on the right path, but not about the timing. So it was again same line like a Fed, but the next move will be a cut, but not sure when it will start cutting the rates. And the governor actually said we are looking beyond temporary period when we expect CPI to return to target, but there and the economy is also showing distinct terms of upturn. So they are looking beyond short term. Therefore, they will not be hurrying to cut the rate. So that's the overall picture on inflation, and that's what the market was continuously looking at, because any clear and distinct indication on rate cuts by major central banks will be what that gives the direction to the next direction to the markets. US was not far behind on inflation indication because the prices paid component of the Philadelphia Fed non-manufacturing survey fell much more than expected, to 30.3, and that's the lowest reading that we have seen on the prices paid component since June. So again, some more news on inflation related. Yeah, but on other data, the conference board's leading indicator index was once again in the negative. It is for 23rd month straight loss for the index, although the conference board has now stated that the earlier assessment that the US economy will fall into recession in Q2 may have to be relooked at. So I think they are also reassessing based on the surprising resilience that the US economy has shown. On the markets, US markets were negative more on profit taking, but also led by weakness in the Nasdaq index, where people were slightly nervous ahead of the Nvidia's numbers, and after raising expectations to a very high level, there is scope for disappointment. That led to stocks getting some sell off, but nothing to change the trend as such. Then Chinese stocks did not really gain, even though they cut the rate by 0.25% for the 5-year tenor. European markets were in the negative after a strong rise in the previous day. Now, on the currencies, Japanese yen has been in the focus because the central bankers are vocal about its recent move. But although it fell below 150 in yesterday's trading, again back above 150, and I think is a slow journey towards 152 is on the cards, unless they meet with some strong intervention. Sterling gained after Bailey said that the economy could be picking up steam after falling into recession in late 2023. As I said, the current account data in euro area grew to 32 billion. That's equivalent of $34.5 billion in December. And the overall full year surplus for the euro area is about 130 billion, and that's quite a good number. When you compare it with other major economies, this is a good number to look at. And if you have to compare with the US, they have annual deficit of over 200 billion. That's a current account deficit, and what we are talking on Eurozone is a current account surplus. And we are seeing that the trade numbers in Eurozone is also improving, and that actually gave rise to euro jumping from below 1.08 to as high as 1.0835. Not a big move follow through since then, but it's significant that euro has shown a lot of resilience after taking cues from some improved data recently. Obviously, the euro's overall resilience is also drawn not only from the cyclical indicators, but also from the structural issue, like debt to GDP ratio, fiscal deficit ratio. All these things score much better compared to the US economy. Yeah, I mean, finally, on to the rupee. There was a strong selling interest right from the open yesterday, piercing 83 very sustainably and touching as low as 82.90, where we saw some interest from rather the PSU banks rising. Yeah, I think flows have been good as far as the Indian rupee is concerned. We have touched the one hurdle at 82.90 and bounced. Maybe if it breaks the next hurdle, which may be more difficult to cross, would be 82.80, at least until we have indications about the future course of the monetary policy in Fed and other major countries. So, but looking ahead to the day, again, we don't have too much of data, but in its absence, market once again looks to indications on monetary policy, which can emerge from the Fed minutes that is due later tonight. The minutes will surely provide a greater degree of clarity on central bank's assessment of inflation outlook, and also the possible timing of the first rate cut. So based on the recent comments of various Fed officials, which we have been sharing with you, the last meeting minutes may signal limited interest for immediate rate cuts in response to stagnating progress on disinflation, because the recent CPI and PPI numbers were not encouraging for people looking for early rate cuts. So there has been a sizable, pruning of the rate cut expectations from various economies, including US, US, Europe, and UK, and that's probably one that is keeping the risk sentiment also somewhat in check. Thank you.
Thank you, JK, and that was quite a good commentary. And just quickly summarizing, one thing which I found surprising was, of course, the Australian Central Bank minutes, which showed the possibility of a hike when the world has been talking about cuts. Now, this is a very contrasting picture and a very important picture. So this is something to take note of. Canadian inflation, on the other hand, slowed, and markets have been speculating that Canada may be the first country to cut rates in the DM segment, of course. UK MPC members reaffirmed that rate cut is on the cards, but market doesn't have the timing of the rate cuts right. And Japanese yen is in the limelight as BOJ officials become more vocal about the recent depreciation in the yen. And Eurozone current account data showed a surplus of 32 billion euros, and this trade number has been improving. This has caused some rally in the euro currency as well. For rupee, we gained some strength yesterday, but remained well supported at 82.90. As JK mentioned, a break can lead to a move towards a more important supporting region of 82.80. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.